Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. The Talking Point today are the views of Aditya Suresh, Head of Research and Strategy at Macquarie Group India. We will be talking to him about whether the SVB crisis impacts the interest rate trajectory and the sentiment around that and the resultant impact on risk assets. Are Indian markets fairly valued, or is there room for further correction? Is the bearish sentiment around banks in light of SVB and otherwise provide a good buying opportunity for the financial space, which according to Macquarie stand the best chance of earnings upgrades despite the higher base? And of course, we talked to him about themes that could do well over the longer horizon. He joins us right now on the show. Aditya, great having you. Thanks for joining in. Hope all is well.
Thank you, Neeraj. Thank you for having me on the show.
Yeah, the pleasure is ours. Aditya, interesting note, and I want to peel off one of the pieces one by one. But before I get to the note, just a broad brush, if you have written and if you are in a position to talk about whether the SVB crisis impact is behind risk assets at large, or is it a bit of an unknown territory right now?
I think we are still in unknown territory. That there is still a lot of water to flow is the honest assessment. From an India market perspective, I think as you kind of point out, it's the impact is going to be in terms of what the Fed does and therefore what the RBI does, and therefore the resultant impact on risk assets. I think it's still early days. From a kind of direct exposure perspective, that seems a bit limited right now.
Okay, that's the big elephant in the room. The Fed meeting next week, and then the RBI first week of April. Do both of these have the potency to change the direction of equity markets one way or the other?
Both on its own big events, and clearly big kind of variables here to kind of monitor, Neeraj. But if I just had to take a few steps back and even think about like how we're positioned, right? So like at the start of the year, what we were basically saying is that from a India perspective, we pull back by about 10% and we underperform by about 15 was kind of our base case position. And that really was premised on a few factors which are not even tied to SVB or any of this, right? Because what we're basically saying is that earnings growth in itself, for consensus, there are high expectations, and those expectations need to be kind of toned down. Point two is on valuations, and therefore the kind of lack of that the foreign kind of buying here. And point three is more generally about the theme of this catch up in bank deposit rates, and therefore the kind of liquidity support domestically which we have had, that kind of fading in 23. So I think the way the SVB kind of issue kind of plays out is to the extent we were to kind of see a change in the RBI position and therefore change that deposit rate trajectory. That has impacts here to kind of consider. But even without all these kind of all these events, the backdrop still was fairly cautious for this year.
In your note, I read with interest that you mentioned that across measures versus its own traded history, aggregate India valuations remain rich, but at the same time, India's premium versus the world EM has now corrected quite materially by virtue of the fact that we haven't moved anywhere and the other markets have moved. Now, typically in such a scenario, Aditya, a few of your peers have pointed out that after such a bout of underperformance, India has typically bounced back and done well. Are you in the same camp that there could, even if aggregate valuations remain rich, there could be a tactical bounce simply or by virtue of the underperformance that India has had in the last few months?
So Neeraj, that's not a view which I share here, at least on a say 6-month basis. I think there's a lot more water to flow is our position. So in Nifty terms, I'm more in the camp that we probably retrace towards 16,000 and rally towards 18,000, right, over the next, say, 6-12 months. And again, it's premised on the similar points which I was making, is that I think if I think about earnings growth, foreign flows, domestic flows as the key kind of drivers of markets, I think all three factors are not working for you. And in particular on earnings in itself. And you've seen quite a few of these stocks where you've had high growth expectations, and simply meeting expectations is not enough to rally, right? And we're not really finding too much in terms of areas, even across sectors, where we can see that earnings upgrade cycle as yet. I think we're still in that kind of in that cut phase across several sectors.
Okay. Yeah, and I was seeing that, and I'll come to the earnings in a bit, but just one quick point therefore. So to your mind, the aggregate valuations relative to the other EMs are not so benign, even if they have come off so much. that they would make a global investor think that, hey, even if the earnings growth is skeptical, let me buy into it because the market has fallen a lot already?
Yeah. Again, on a very, very short-term tactical basis, perhaps. But if I had to kind of take a few steps back again, Neeraj, so I think what we have found to have a very strong predictive power, if I may, of kind of how Indian markets are kind of behaved, is that when you kind of plot, let's say MSCI, the India, the index, and 2-year forward consensus earnings growth expectations, right? Or just two-year forward EPS, the regression is incredibly tight. It's almost like one, right, over the past, say, 20 years. And the point we're trying to get at is that we're right now at a phase where those expectations are still being toned down, right? And there's a high ask, and the expectations are being toned down, and you're really growing into these numbers. And if you kind of buy into consensus numbers, following the pullback so far this year, perhaps you're closer to fair value. If you kind of buy into the Macquarie bottom-up estimate, which is calling for about, say, 12% EPS growth over the next, say, 2 years, that would still leave you with, say, 5-7% downside compared to where we are today.
Okay. But 5-7% downside is not 16,000. So you presume that there will be some more overshooting of what could be normal acceptable valuation levels because of maybe equity risk premium or otherwise.
Absolutely, right. So I think these things never kind of hit fair value and pause. So yeah. But you're correct. So if I had to think about fair value, maybe 5-7% below from where we are today.
Got it. Now, Aditya, would earnings be the principal driver for this kind of a move? In that, what I mean to ask is, just so that there is clarity amongst viewers as well, that would it take, say, at the end of Q4 or Q1 FY24, a consensus earnings reportage which is lower than estimated, and outlook which is murkier than anticipated, and therefore an earnings downgrade to FY24 earnings estimates, which will drive this? Or could the markets discount it way before because of multiple other factors?
No, I think the earnings picture again, right? Just kind of think about this across sectors, and the regression which I was speaking about again, or how we thinking about markets, that's more on a 2-year forward basis, rather than it just being fiscal 24. So we're really speaking about now, like what's happening in March 25 earnings, right? And so it's that 2-year kind of growth narrative which kind of matters. Now, just to give you a flavor of kind of what I think is already numbers, right? So, for example, in financials, that's been an area where across all the other sectors, financials has been one space where you've seen upgrades, where expectations have been high and there have been upgrades, right? And this has been clearly been driven by your credit growth story, which still is something which we're constructive on. Credit cost in itself has been benign. Sure, there is some net interest margin risk on the downside to maybe absorb, but I think at least within our sector estimates, it seems captured. So there is still growth within the banks, but that's kind of in the numbers, right? So incrementally, for us to say that India is going to rally because the banks are going to drive this, I think what you really need to see is far stronger growth or far better kind of credit performance, right? And that's not where we're positioned. IT again, this is an area where there is, whilst people speak about recessions and all these things, and therefore the cuts to revenue estimates, when you look at consensus revenue estimates for IT, that's fairly stable, and the growth already kind of baked into numbers is about 12-13%. There's been a lot of cuts to margin. So there's probably a bit of a balancing act there, right? Where maybe margins kind of go up, but revenue estimates being cut. Our numbers are above consensus, but yeah, on its own, I think it's not going to drive a big meaningful kind of re-rating here for markets, right? I think the one area or theme where you could see a rally is basically on, for example, in the consumer names, right? Now in the consumer names, what's really happened here is that you've had a very sharp cut in margin estimates, right? Whether it be gross margins, EBITDA margins, all these things, and incrementally to the extent that we were able to see evidence that there is a strong kind of recovery story in terms of consumer demand, and this will be more mass and rural kind of that kind of category, because the urban, the top end is still okay. Then maybe there is a case to be made that sector could see some upgrades, and therefore we could see some positivity there. But even that, Neeraj, means so on the real-time data which we are tracking, mass consumer sentiment remains fairly soft on the RBI surveys. Rural indicators are mixed at best. At the margin, maybe slightly improving, but mixed. So we're not really seeing clearly kind of which pockets are going to give you that big earnings upgrade story to therefore drive markets higher. And that I think is a key kind of challenge here for us, that we need to kind of reset expectations and then we kind of work from there. But there's still a lot of water to flow.
Wow. Yeah, and it's interesting because a bunch of economists have been talking about how they are not concerned about the urban rural demand as much for 2023 as they are about urban discretionary, because of all the government measures and otherwise that rural may just come back. So I will be keenly watching out for what you just mentioned, which is the mass market consumer demand. Now, in your note, Aditya, you already spoke about financials, where you have this view. And the interesting piece, I just want to probe that a little bit more, which is that if Indian financials, as your note suggests, are at a 20% discount to MSCI India, and if indeed earnings growth does turn to be strong, then does the market discount the upcoming interest rate trajectory moving lower and therefore a NIM contraction, or will the markets reward the current earnings growth when it gets reported?
I think this is more just a reflection that, financials is still an area where we have high visibility and high confidence on the path forward in terms of earnings. Financials compared to all the other sectors, I think that's probably an area where we have the highest confidence, and in particular within the large cap banks, and whether it be credit growth, credit cost, provisioning, all these things, we are fairly comfortable. So I think to that extent, in a broader kind of macro backdrop or market backdrop, which is challenging, financials remains a key kind of sector positioning here for us, right? Now, does that mean that we see an outright substantial rally in a kind of challenged market? That perhaps that holds off a bit, but in terms of where we want to be positioned and kind of using that earnings visibility as a proxy, we would still be with the large cap private banks.
Okay.
I think you're clearly in a dynamic where, at least in terms of whether it be HDFC, ICICI, all these kind of stocks, we want to seek exposure, right? And maybe we have to wait there for a few quarters, but the underlying metrics which these companies are reporting, we like that.
By the way, I'm not asking you to name ideas, but your note, there's a very interesting slide on page number 28, which speaks about companies wherein Macquarie has an overweight, and relative to their own valuations, these stocks are available much cheaper, and SBI kind of tops that list. So is one to assume that the probability of the gains remains the highest in some of those names? They may or may not happen, but the probability remains the highest there, according to you guys?
That's kind of how we're thinking about that particular exhibit, Neeraj, where what we're trying to show is that one is where we are meaningfully above consensus from a kind of estimates perspective, and where stocks are meaningfully below their own kind of valuations, right? And so the names you point out, yeah, that does kind of screen very favorably. So we're looking for those type of names where we have these differentiated kind of bottom-up kind of calls above below consensus, and where kind of valuations are meaningfully away from their own kind of history.
Sure. One of the sectoral themes that you've pointed out in the estimates is industrials, which I thought you were pointing out that seems to be a strong sector. Now, my question is more around the starting valuations that we have for that pocket currently, and therefore the probability of gains even 2 years out, considering that you are already buying them at expensive valuations. The bulls, Aditya, tell me that when I'm looking at those valuations currently, which are rich, I'm looking at depressed earnings valuations. And when the cycle turns, the valuations will suddenly start to look a lot more cheap. How are you thinking about industrials?
I think it's similar to the financials. This is an area where we're feeling comfortable with the earnings backdrop. And this is an area where we want to be positioned. And that's clearly been driven by what we're seeing on government capex and kind of the order backlogs, all these things. And as these kind of backlog gets executed, there is a margin expansion story as well, which we assume in our estimates. So there is a lot of growth in our numbers for some of these industrial names. We are above consensus on quite a few of these stocks. But I think you're correct that the starting valuation itself is not speaking for outsized kind of gains here in terms of stock performance. That's not what we're seeing. Maybe 6 months back, 12 months back, that's something which we're calling for. But today, again, it's modest gains compared to where we are today. In a broader market backdrop, we still want to seek exposure in industrials given the earnings visibility.
Got it. Got it. Aditya, my final question. Most large investors will say, buy fear, sell greed. There is fear on the street when it comes to healthcare. From amongst all the themes that you've spoken about in the note, in the pictorial depiction, the only one which didn't have a qualifying statement was the healthcare index. My question is, at this point of time, wherein almost everybody's underweight, the stocks are underperforming, earnings are depressed, what do you think about the outlook on earnings, say, over a 2-year period? Can there be a recovery, or is it difficult to say?
So our analyst is very constructive on selected healthcare names, particularly the larger ones. He thinks that the domestic market, we're going to see good growth after a fairly kind of period of benign growth, if I may. He's constructive on the US business for some of these companies as well, and that kind of product launches. And so some of these large caps are giving us, say, 20-25% kind of ROCs with, let's say, mid-teens kind of or high teens EPS growth outlook, and still kind of trading at a market multiple, right? And so some of these large cap names in healthcare look really interesting for us. But it's not a blanket statement that buy India healthcare. It's still a very selective comment, Neeraj.
Okay, but within that tepid space, there are pockets of exuberance, if you will. Great.
Absolutely, yeah.
Aditya, great talking to you. Thank you so much for giving us a lowdown on this note, which spoke at length about earnings. We try to capture as much as we can in this 20-minute interaction. But lovely talking to you, and look forward to having you more often on the platform.
Neeraj, thank you for hosting me.
Now, the pleasure was ours. Viewers, thanks for tuning into this edition of The Talking Point.